Good evening, how are you? Can you hear me well? All right, so I hope you're all good. So let's start. Last week we discussed the end of a contract, so how a contract ends or is discharged. We discussed four main ways a contract is ended. Um, First, by performance, second, by breach. But remember that the breach has to be fundamental. There has to be a breach of the condition. When a warranty, a minor term, is breached, the contract is not ended. And then also by agreement. So there's another agreement to either change or end a current agreement. And the fourth way a contract ends is by frustration. And frustration, you learned, it is an outside unforeseen event that makes performance impossible. And then we also looked at remedies for contract law, mainly for breaches. So most of those remedies, they are available for a victim of a breaching party in an agreement. So you can review that. And we started chapter 10 discussing about agency law, and we've seen several situations in which an agent working for or on behalf of a principal deals with third parties, such as we saw um, travel agent, insurance agent, and so on and so forth. We saw that an agency relationship starts by when the principal grants authority to the agent, and that authority may be actual authority or may be a parent one. And in terms of a parent, remember that it is in the eyes of the third party that it is apparent that the agent has authority. The very simple example, and also one small case scenario we discussed last week, is if you enter a store and you talk to the salesperson, it is apparent to you that salesperson has authority to sell, to negotiate goods with you. So that's apparent authority. And we saw a lot of duties on agents, and I told you that those duties, they are also relevant for uh, this evening's lecture, mainly in terms of partnership, because partners, they are agents of one another. So let's look at types of business organization. We will be focusing on those three: sole proprietorship, partnership, and corporation. Corporation will be in chapter 11, but there are others which we don't focus on this course. We'll see. I'll just mention to you some in a little while. So, as I told you, we have non-profit profit society. There's also holding company. There's also joint venture. Well, non-profit society is a society that is there um, in which there are no shareholders, because the society is not there to make profits to be shared among their shareholders. A non-profit society, they may make money, but the money has to be fully used in the management and running of the activities of the society. So that's why it's a non-profit society, because whatever money they make, they could make money by donations, by selling products, but this money would need to be used in the activities of the society. A holding company is just a corporation in general, but the holding company, the business activity of a holding company is to own shares of other companies. So big corporations, they usually have this structure. So let me exemplify you with Tim Hortons. Tim Hortons is owned by this company called 3G Capital. So 3G Capital is a holding company. They own Tim Hortons, they own other companies. Okay, so they don't have a business itself, but they own shares of other corporations for tax purposes, for asset protection, and some other reasons. And a joint venture is not a type of a business organization itself. A joint venture is just a legal concept, which is when two corporations join resources, could be financial resources, could be technological resources, any type of resources, to develop a specific project. So let's say um, two pharmaceutical companies are now in a joint venture trying to find a vaccine or a new drug, a new medicine for COVID-19. So it's the joint venture is could be a contract, so it's a contractual joint venture. So those two companies would be in a contract, and there would be obligations and rights for both companies. Or those two companies, they could set up a new company only for this project, only to find a new vaccine or a new drug. So again, joint venture itself is not a business organization, but it's a legal concept in which two companies, either via a contract or via a new corporation, they work together, join resources to develop a project. Okay, so let's look at sole proprietorship. This is the one of the most simple ways to do business because it is when you do business on your own. With a sole proprietorship, you don't have partners, you don't have anyone else doing business with you. You may have employees, but they are employees. They may be casual employees, they may be hourly employees, they may be permanent or temporary employees, but you are the only one owning the business. Actually, you are the business. You as a person, you are the business. So this is sole proprietorship. You can have a name for your sole proprietorship, but you are the business. So it means you cannot sell your business. Why? Because sole proprietorship is when we are the business. Examples could be a gardener, could be a business consultant, could be a lawyer, could be a dentist, could be a doctor. So whenever someone works on their own, they may be sole proprietors. It doesn't mean that they cannot start their own corporation. Yes, they can, but I will detail this a little later in chapter 11. For now, let's just keep in mind that when you are doing business on your own, you are a sole proprietor. And you may register your sole proprietorship, but um, it's just straightforward. You start doing business as per your skills, and then you are a sole proprietor. And if you have an office for your sole proprietorship, you need to comply with zoning bylaws. As I said, you may need to register your sole proprietorship. You may need licensing, depending on the activities you deliver. And if you have employees, you have to comply with employment legislation, etc. So the main benefit of sole proprietorship is that it is very straightforward. You just do business on your own and you have a sole proprietorship. However, the biggest disadvantage is related to liability for financial obligations. So if you have any drawbacks, financial drawbacks, your personal assets, they are available to your creditors. So that's why we call it unlimited liability for financial obligations. So let's say I'm a lawyer, I'm a sole proprietor, working on my own, and I cause loss to one of my clients. So my client would sue me, would sue my sole proprietorship, but if my sole proprietorship does not have enough assets, enough money to pay for those losses, my client, the victim, could pursue my personal assets, my savings, my house, any other assets I have on a personal level. So this is the biggest disadvantage for sole proprietorship. One of the ways to reduce this risk is to have liability insurance. So you can, this is cost, but at least up to a certain amount, up to certain events, the insurance, they may cover any issues, financial issues you may face while um, performing the business of your sole proprietorship. Okay? And also there's vicarious liability, but this is present in partnerships and corporations. You already know this. So whenever an employee causes damages or losses to others in the course of their employment, the employer is vicarious liable. The employer may have to pay the compensation. And again, that's why liability insurance is available, and most business people have liability insurance. Okay, so that's sole proprietorship. Straightforward, simple. If you want to have a partner, then you can decide to go on business through a partnership or a corporation. But for now, let's just focus on partnership. So if you're doing business on your own, you have no other partners, you may be a sole proprietor. But now you have one or more partners, then you may have a partnership. Well, a partnership, it is when two or more people, that's why it is written there, a group of people. So two or more people, they do business together, and they also have the aim of making a profit. Okay? And the partnership is not a separate legal entity. It is the same thing as the sole proprietorship. I told you that the sole proprietorship is you. The partnership is actually the partners. The partners are the partnership. There isn't an entity, legal entity, that is the partnership. Okay? So you come up with a name. By the way, I have uploaded handouts to you how to register a partnership, advantages and disadvantages of partnership, sole proprietorship, and corporation. So, but this is extra for you. So, partnership, the partners, they are the partnership. Okay. And how is a partnership created? Well, the best way to create a partnership is to create by contract. But there's also another way in which a partnership may be created, and here you have to be very cautious. Well, first of all, let me tell you that there's a Partnership Act, the legislation, which is provincial, so each province will have their Partnership Act. So the Partnership Act prescribes that if you are doing business with someone else aiming at making profits, even if you have not formally created a partnership, you are actually in a partnership. This is what the Partnership Act says. So let me give you this example. Long weekend. We just had a long weekend. Let's say you and your neighbor, you and a friend, you decided to bake some muffins and sell them at Stanley Park. Well, I know with all this COVID-19, you couldn't do this, but let's say it was last year. So you and your friend, you baked muffins to sell at Stanley Park to make some money. So even though you were not formally, uh, even though you have not formed a partnership with an agreement, etc., but the Partnership Act says that you were in a partnership because you have created this partnership by inadvertence. You were not intentionally creating it, but because you were together with someone else and aiming at making profits, you were in a partnership. So you have to be very cautious about this. And I'll emphasize this as we move forward. If you own property in common, you are not automatically in a partnership. So let's say now you and a friend, you and a neighbor, you own property in common. It doesn't necessarily mean you are in a partnership. You may have a partnership that owns property, houses, townhouses, vacation homes, etc., to make money. You could do this. But the fact that you own property in common uh, does not determine that you are in a partnership unless you intentionally want it. Okay? So this creation by inadvertence, the example I gave you on the muffin in Stanley Park, it is understood as a partnership created by presumption. It is presumed you have created a partnership. Why? Because you and your friend, you join capital, resources, you prepare the muffins, and then you sold and you aimed at making profits. So people in business, they have to be very cautious not to create partnerships by inadvertence because they may carry liability and they may be in a lot of trouble with this. I will emphasize this in a little while. The best way to create a partnership, as I said, is by contract. And we have just studied contract law. So you come up with a partnership agreement, um, and all rights and obligations of partners will be there. There's also the need to follow the Partnership Act. So my recommendation is always to seek legal advice for a partnership agreement, one that is customized to your needs, to the partner's needs. As I told you last week, you can go online, you can find partnership agreement templates, but that's not the best way. You may be saving money here, but because of liability in the future risks, you would actually not be saving in an intelligent way. So I would always recommend people to seek legal advice for a partnership agreement. And the agreement will deal with the duties, how profits are shared. So let's say you and your partner are starting a partnership, and let's say you are investing 80%, your partner only 20%. So you may describe in the partnership agreement that profits will be shared in an 80-20% basis as per each partner's interest in the partnership. You can also add in the partnership agreement limitations on the powers of the partnership or limitations on the capacity of the partnership. Remember, in chapter 7, we looked at capacity for contracts. And if you want to limit the capacity for your partnership to do business, in certain circumstances or with certain entities, you should limit in the agreement. You could also have disputes, etc. So the more detailed the partnership agreement is, the better off the partners will be in case of any um, disputes or issues they face during the partnership. Registration. So registration is required in BC. As I said, the Partnership Act is provincial. I cannot say for all provinces in Canada, but I can say for BC. So in BC, registration is required. And if you don't register, you may have to pay a fine. So again, that partnership you created with your friend to sell muffins at Stanley Park, if the government found out you had not registered, you could be fined. Okay, so this is one consequence here, but there are other consequences. So partners, they can agree on the partnership agreement as they wish, as they want, except some issues that they cannot change, but those are very few. Um, However, if partners don't describe some aspects in their agreement, or if they don't have a written agreement, a detailed agreement, then the Partnership Act will set the rules. So what I'm saying is that the agreement is the law among the partners, and if the agreement is silent in any aspect, then the Partnership Act will rule it. And what I'm saying is, if partners have not agreed on how they will share profits, the Partnership Act says that profits and losses will be shared equally, for example. The Act also prevents salaries to be paid to the partners because partners are there to make profits, not a salary. Okay? So if you are a partner, you are making profit whenever your business activity is profitable, but you don't make salaries. And one benefit here of a partnership is that the Partnership Act says that if there's a major change in the partnership, unanimous agreement is required. So let's say the example I gave you about you investing 80% and your partner investing 20%. So you have the majority of the interest in the partnership. So you could use this majority to force as many changes as you want on your partner because you have the majority. But for a partnership, this is not true for major changes. Because if there's a major change, unanimous agreement is required. So let's say you have a partnership. Uh, the partnership business is in BC and you want to move it to Alberta. So this is a major change. And if you want to move it, but your partner doesn't want, you cannot, because a major change will always require unanimous agreement. This is a protection for partners in a partnership, which is very interesting. There's fiduciary duty, and here I will not spend too much time because we've seen this already in agency law. So this is the same for partners because partners are agents of one another. So the same rules apply in here. Liability. So because agency law applies, it means that uh, a partner is liable for all other partners' wrongdoings and vice versa. So here is the main disadvantage of a partnership because you may be liable for some wrongdoing of your partner. And remember the example on making muffins and selling them at Stanley Park? So let's say your partner made a mistake and caused losses to one of the clients. And then this client, they may come and sue you, go after your personal assets. But it was your partner who did the wrongdoing. The law, this is irrelevant for the law. because the law says that partners are agents of one another. In other words, they are liable for one another wrongdoings. Okay, so this is very, very important. One other thing is, so let me give you this example. You have 80% interest of a partnership. Your partner has 20. Okay, your partnership owes 10,000 to a bank, let's say. So the bank can sue the partnership or all the partners. And even the partner who has only 20%, this partner may have to pay the full 10,000 to the bank. But then you could ask yourself, why? Why the partner with 20% would have to pay the full amount to the bank? Well, because the agreement on the 80% and 20%, this agreement is only binding to the partners, not to third parties. Again, you may remember the concept of privity of contract. Privity of contract is that concept that says a contract only affects the parties to it. So you and your partner, you are in the partnership agreement. So the fact that you hold 80% interest and your partner 20% interest, this agreement only affects the two of you. It does not affect third parties. So yes, the bank could come and sue your partner that has only 20% interest, but let's say in a personal life may be richer, and this partner may have to pay the full amount, 10,000. A consequence of this would be that this partner, after paying the 10,000, would then sue you to recover 80% and would sue you based on your partnership agreement. Okay? So this is very important as well. Partners are liable to one another. Partners are liable for the wrongdoings of the other partners or employees. And third parties, they are not affected by the agreement of the partners. Okay? So again, one way to reduce the risk here would be to have liability insurance. Okay? So this is what I just said. Unlimited liability. Oh, sorry. I talked about the liability of partners, but as in sole proprietorship, here for partnership, there's also unlimited liability, meaning that if the partnership cannot afford to pay their losses, the partner's own assets, personal assets, will be at risk. So creditors, they may pursue the partner's personal assets. Okay, that is very, very important. And the example I gave you about the bank collecting 10,000 from only one partner is what I'm saying here. A third party can collect from any partner, because that agreement does not affect the third party. Okay? So a partnership may be dissolved, may be ended. And how do you do this? Well, a partner sends a notice to the other partner saying, hey, I don't want to be in the partnership anymore. Because a partnership requires two or more partners. In a partnership with only two partners, if one wants to dissolve, the partnership cannot exist anymore. Or if one of the partners passes away, goes bankrupt, or becomes insolvent, the partnership is also ended. Okay? This is just distributing any assets that are left. And here's some advantages. The first advantage is that you can use insurance, liability insurance, to reduce the risk, as I exemplified before. Also, the unanimous consent, remember, for major changes. It is very inexpensive. You would spend $40, $50 to register, you would spend more money to hire a lawyer and to have a customized partnership agreement. But you don't need to be paying a lawyer to maintain. It's very straightforward. So everything I told you until now about partnership is related to a general partnership. We also have limited partnership. And a limited partnership, actually, it is a limited partner. It is a partnership in which one of the partners has to be a general partner, but the other can be a limited one. Why would you want to be a limited partner? Well, you want to limit your liability. This is very beneficial for investors. So let's say you are a scientist and it seems you may have found a vaccine for COVID-19, but you need money to develop, to do more tests, etc. So I may invest or someone may invest, but I don't want to have, or the investor doesn't want to have their assets at risk. So they become a limited partner. For a person to become a limited partner, they need to meet two requirements. First one, they cannot manage the partnership, so they cannot be involved in the daily business of the partnership. And the second requirement is they have to be registered as a limited partner. Okay? So once those two requirements are met, the limited partner will only lose the amount they have invested. They cannot lose more. So that's why they are limited partners. Okay? So highly used for investors and a very interesting concept to avoid unlimited liability. The liability for the general partner is still unlimited, but not for the limited partner. And another type of partnership we have is the LLP, the limited liability partnerships. So this is highly used by professionals. You can just Google if you want accountant LLP, or you may look at KPMG, if I'm not mistaken, those big firms, law firms as well. They usually go for limited liability partnerships. Why? Well, first of all, in some provinces, this LLP is only allowed for professions. So it became a custom to use LLP for professions. And by being a limited liability partner, by being a partner in an LLP, the partner is limited. They limit their liability to their own wrongdoings. They are not liable for their partner's wrongdoings. So this is a protection for them. They are still unlimited liable for their own wrongdoings, but not for someone else's or the other partner's wrongdoings. And when you register an LLP, this LLP acronym has to be in the name. So if you just Google law firms, if you try to find some law firms, some accountant firms, you will see most of them, not all, but most of them will be LLPs. This is very common for professions. Okay, so those are the three types of partnerships we have: general partnership, limited partnership, or it's better put limited partner, and the LLP, the limited liability partnerships. Okay, we've gone through a joint venture already. I told you before in the beginning, and here you have just a chart summarizing. So let's practice this question. All right, so I see D. D is saying The Partnership Act sets out the provisions that will govern the relations among the partners. That is correct. Unless the partners agreed otherwise. This is also correct. So both parts of the statement are correct. Yes, D is the right answer. Very good. So any questions here? Any questions on, let me just go one by one here. So A, it is saying the Partnership Act always overrides provisions contrary to it set out by the partners in the agreement. No, no, no. The agreement always, not always, but in most circumstances overrides the act. It is on the contrary. The Canadian Partnership Act, well, it doesn't exist because the Partnership Act is provincial. So that's why B is not right. C, Partnership Act states clearly that a partnership is only created by agreement. No, we saw that a partnership may be created by inadvertence. The example on the muffins and Stanley Park. So C is not right either. E, when in conflict, the terms of the Federal Partnership Act, well, Federal Partnership Act doesn't exist. It is a provincial act. All right, so that's agency law and partnership. Any questions? Any doubts?